Hello and welcome to Nowhere to Invest. I'm Robert Sadler, I'm the founder of Nowhere to Invest, and in this video we're going to tackle the difficult question of which investments to make during an economic crisis when you need to have money on hand. So by the time you finish watching this video, you will know which investments don't belong in your on-hand portfolio and which investments are ideal for an on-hand portfolio. So this is the second of a series of videos in which I tackle the general question of where to invest during an economic crisis, particularly because in the year 2020, when this is being filmed, we are in the middle of an economic crisis, but also crises come and go. The economy is cyclical and it's good to be prepared for the next crisis, and it's ideal to start preparing for that if you can when times are good, but there are options you have when times are not so good. So in the first video, I introduced the concept of the on-hand or emergency fund portfolio, and in this video, I'm going to go a little bit more specific about the types of investments that both belong and don't belong in this type of portfolio. So the first investment we're going to look at is real estate. And real estate is a very popular asset class. It's invested in obviously by large corporate investors, but also many of my clients like to invest in real estate. They like to have a rental property or two, or many others simply like to buy properties, fix them up, and then sell them on. So it's a very common type of investment across the sort of broad spectrum of different types of investors, whether those are retail investors like most of us are, or the big corporate and professional investors. So is real estate an ideal asset to have in your on-hand portfolio? I would say probably not. And the reason for that is that while you can certainly enjoy some very good returns from real estate, the biggest issue with real estate is that it is an illiquid investment. When we say illiquid, we mean that it can take a very long time for you to get your money back out of that investment when you need it. The other issue with real estate, particularly the way most people make a real estate investment, which is typically buying a house or several houses, it incorporates a large percentage of your wealth. So for some people, their real estate portfolio may be the entirety of their wealth. And the issue there is, if, for example, you have a house that's worth, a rental property that's worth, say, $500,000, and you need perhaps maybe $50,000 to deal with a short-term emergency, it can be a real problem if you need to sell that entire house just to get back 50 grand. It may not be what you want to do. The other issue is that the length of time that it would take you to sell that house in a crisis could even be years. I've had it happen to me where I was trying to buy a house and it took me 2 years to buy the house because of various legal issues that we discovered during the purchasing process. But also, even in good times, when there aren't any problems, it can still take a month, several months, even in a good market, to sell a house. So, not really ideal if you have an emergency, something that needs to be tackled or taken care of now, and all of your wealth is in a real estate investment, and you can't get to it quickly or easily. So, for that reason, I would not recommend a real estate investment as part of your on-hand portfolio. Another option, of course, is stocks. Stocks tend to be at the other end of the sort of liquidity spectrum. In other words, it can be quite easy and quick to sell stocks. The trouble with stocks is that they can be quite volatile, and the value of stocks typically, or a stock portfolio value typically falls at the precise moment when you need to have access to it. So we all know that stock markets tend to crash or fall significantly in value during an economic crisis. But that may also be the same time that you perhaps lose your job, or if you're self-employed, that may be the time when your revenues are lower. So this is the time that you need to have access to your funds, but you may find that the stock market has lost 30-35%, maybe more, of its value. This is what happened in 2020 with the coronavirus pandemic. So if you lose 35% of your wealth right at the moment when you really need it, that can be a real problem for many people. So again, here we have a fairly liquid asset, but it's a very volatile asset, and the value of this asset tends to move along with the economy. So ideally, probably not an asset class that you want to have in a on-hand portfolio. The next asset that I want to look at is cryptocurrency. So I've been looking very closely at cryptocurrency over the past 6 months. The reason being because it's a new and exciting asset class. The issues, I have two broad issues with cryptocurrencies, at least with respect to on-hand portfolios. The first is it's very complex and difficult to understand. So I've been looking at cryptocurrency for 6 months, and I'd be lying to you if I said I truly understood it. I really don't. I'm still sort of figuring it out. And so if professional investors are having difficulty understanding how cryptocurrency works and how its value works, and and whether it's even going to be here in 5 years' time, it's probably not an ideal asset to have in your on-hand portfolio. The other issue with cryptocurrency is that its value tends to be even more volatile than stocks. It doesn't seem to be tied necessarily to what's happening in the economy. And in fact, in the year 2020, when stocks went down 35%, cryptocurrency went down more than, or at least Bitcoin went down more than 62%. So that again would present a problem. If you had all your money tied up in cryptocurrency and the value drops by 60%, that's again is a problem for many people. So probably not an ideal asset to put in your on-hand portfolio. So if you're finding that this information is useful to you, then please go ahead, like the video and subscribe, and we can make sure that you hear more about the other videos later on. Additionally, I'll give you instructions towards the end of this video of where you can find my free report and also a free email course that will be customized to your particular concern. So the first asset class that I want to look at that I think is probably ideal for an on-hand portfolio, and it's certainly one I keep in mind, is the most obvious one, cash. And why cash? Well, cash is king, as they say. It is completely liquid. It is the most liquid asset, and if you have 6 months of living expenses in a bank account, typically that's pretty reliable. You can be reasonably sure it's going to be there when you need it. I will note a couple of issues that I do have with cash. One is inflation. So inflation erodes the value of cash over time. So you may be getting some amount of interest or published interest rate on your savings account, but it's likely being eroded by inflation. So I think average inflation in the United States is something like 3%. And if you're earning less than that in interest, then the value of your cash is declining over time. So that will be something you need to keep in mind, and that you're going to have to keep reviewing what 6 months of living expenses are for you, and make sure you keep that savings account topped up. The other issue, of course, and not to scare people, but it's happened in the past, you have bank failures. So if you have all of your cash in a savings account at one bank, if that bank goes under, there is the possibility of losing a portion of those funds, depending on how much they are, and depending on how much insurance the government is able to provide. But it's something to keep in mind, because people have been caught out by this in the past, and they have lost money when banks have failed. One ideal way to deal with that, perhaps, is just to have your cash in different savings accounts at different banks. That's an idea. The next asset that I personally keep in my on-hand portfolio, and for me is the most important one, is gold. Now, gold does tend to divide opinion. Some people really like it. Other people don't want anything to do with it. It seems to be a fairly political asset class. But leaving politics aside and just looking at the facts, the fact is that gold has had a remarkably stable value for thousands of years. They say that you can buy the same amount of food with an ounce of gold today as you could buy in ancient Rome. So with that in mind, you have a consistent value that you can rely on when you have a certain amount of your assets in gold. The other thing about gold is that you can have it stored for you. You can keep it at home, preferably somewhere secure in the house. So it's relatively versatile like that. The other thing about gold, though, to be aware of is that some people do say that gold can be volatile. And while this is true, gold doesn't tend to be as volatile as stocks, and certainly isn't as volatile as cryptocurrency. But it is important to keep in mind when gold tends to be more volatile and when it's less volatile. And what I've observed when you look at historical gold prices is that the gold price, or at least the growth in the gold price, tends to be flat when economies and stock markets are doing well, and then it tends to be a bit more volatile during the crisis. That being said, when there is an economic crisis, the value of gold tends to rise. And the reason for that is that many people see it as a safe haven for their money. They're unsure about the stability of banks. They're unsure about what's going on with the stock market. So a lot of people around the world tend to buy gold at that point, which causes the price to rise. But typically what I've observed is that usually right after the gold price rises, there is a correction causing the gold price to fall quite a bit. So that's where the volatility comes in. That being said, it doesn't affect my decision whether or not to buy gold or not. I just buy gold because I buy gold for the long term, not for short term gain. And if it's going into an on-hand portfolio, you're not looking to become a millionaire out of your gold purchases. You're looking for something that has a stable value over time and that you can use as a store of your wealth, and it also is reasonably liquid. It doesn't tend to take too long to sell gold, depending on what type of gold you're holding. If you're holding solid gold bars at home, that may take a bit of time to sell, but there are accounts that you can get where your savings are denominated in ounces or grams of gold, and in those cases you can sell the gold and have your money back within a few days. So something to keep in mind, and perhaps maybe don't have all of your on-hand portfolio in gold, perhaps some in cash, some in gold, and then perhaps some in the next asset class that I'd like to talk to you about. So the next asset that you could potentially have in an on-hand portfolio is certificates of deposit. So this will go some way to fixing the issue with inflation. Now, it won't solve it completely, and from what I've observed, certificates of deposit tend to have rates, at least at the time of recording, of less than 1%. And so if you consider that average inflation is around 3%, you're still losing a little bit of money, but it helps to offset it somewhat. And if you don't think that you're going to need that money immediately, then perhaps having a certain amount of your on-hand portfolio in certificates of deposits may make sense, depending on your precise goals and your precise concerns. So, for example, you can get different maturities of certificates of deposit, 1 year, 18 months, 2 years, and so on and so forth. And you can perhaps time the maturities of those certificates such that the money's there when you need it. And so perhaps if, for example, you have 3 months worth of cash and you've got a certificate of deposit that matures in 3 months, then you know that you've got cash coming in 3 months' time. Now, this may be making things a little bit more complex, but if the interest rate in your savings account is an issue for you and you think you can probably wait a little bit more time for your money, then it's something to consider. But you got upsides and downsides there. You've got more interest, a higher interest rate than you would have in your savings account, but you may have to wait a little bit to get your money, or if you take the money out sooner, you will likely have to pay a penalty. So something to think about is another option. The other option that I'd like to discuss is bonds, and typically government bonds. Now, what's the advantage of a government bond, particularly US Treasury? US Treasuries are seen as being a safe haven, safest bonds in the world. So they tend to hold the value reasonably well, but in particular, the value of government bonds tends to move in the opposite direction to the stock market. Typically, not always, but typically. So usually, when you're in a situation where there's an economic crisis, the stock market has crashed, many investors have already moved their money into bonds. And so that, again, much like people moving their money into gold, these investors who are now moving or shifting funds into bonds help to elevate the value of those bonds. So if you bought your bonds when times were going well, then now that times are a little bit more difficult, the value of your bond portfolio may well help to support the overall value of your on-hand portfolio. The other thing about bonds is that they are liquid, particularly US Treasuries. US Treasuries are very liquid, and so you can usually be confident that you can sell them relatively quickly. Now, the only real concern that I have about US Treasuries is that they're quite complex, and so it may require a bit of work on your part to understand how they work, or perhaps take some advice before purchasing these bonds. The other risk to bonds is that they are dependent on the credit rating of the government that issues them. Now, the United States obviously has a very strong credit rating, but things can happen. We've seen in the past during crises where governments may issue a lot of debt. They may start making more welfare payments to people because people are out of work, or they begin all sorts of government initiatives, government investment to stimulate the economy. Now, I have my own thoughts about whether or not that's a good thing or not, but this is what happens. And sometimes these actions taken by government can increase the amount of debt that the government holds, which means that the credit rating for those governments can fall, which means that the value of those bonds can also fall. So it's something to bear in mind. So far in history, we haven't seen the United States or any other major Western governments default on their debt, but that doesn't mean that they can't happen in the future. So something to keep in mind. And for me personally, I don't have any bonds in my on-hand portfolio, but it is an option, and if you're comfortable with it, it's something to explore. Okay, so that wraps things up for this video. Now, having watched this video, you know the investments that you want to perhaps avoid having in your on-hand portfolio, and then also the investments that are most likely ideal to have in your on-hand portfolio. If you have any questions about anything I've discussed, or perhaps even if you disagree with me, please let me know. Leave a comment. If you like the video, go ahead and like it. Subscribe so that you can hear more. But most importantly, if you really need a lot more information, I'm providing a free book and also an email course that is customized for your most pressing investment challenge. So go ahead, click the link below and get hold of both the free book and the free email course. In the next video, I'll be taking things a little bit further and looking at other investment strategies. So in this video, we've taken care of the on-hand portfolio. Once you have that in place, you're ready to start looking at more exciting investments. So come back and make sure you watch the next video. Thank you.